everybody? How the heck are you doing today on Tuesday, April 21st? I continuously remind myself that this is a beautiful time to be alive. Let me really quickly add the old link to the TL here. Boom. Oh, we're going to have to get rid of one of them. Let us get rid of you. Sorry, scammers in the Straits of Hormuz. How is everybody doing today? Welcome to another beautiful day on crypto Twitter. I am going to shill my newsletter, The Smart Economist. Head over to thesmarteconomist.beehive.com to sign up to the newsletter. I've had a beautiful morning, actually. I got to interview Vivek Raman from Etherealize for the Smart Economy podcast, and that was just an awesome interview. Just thoughts firing so rapidly, so many great lines of conversation. We got to talk about a really cool report that Etherealize is going to be releasing soon about how ETH is a fantastic money. And honestly, I've been waiting to talk to Vivek. And let me just, here we go. Tuesday, April 21st. Honestly, I've been waiting to talk to Vivek since, and I kid you not, February of 2025. When I first heard of Etherealize, when all of us first heard of Etherealize and what they're doing in Wall Street and trying to spread the good word of Ethereum behind the closed doors in Wall Street. So yeah, I was really looking forward to the conversation. It was a fantastic conversation. And I cannot wait to share it with you guys over at smarteconomypodcast.com. Just a super fun individual to chat with. The neurons were firing. I did not get through nearly half of the questions I had. Anyways, let's move on to today's news. We have a little bit of follow-up from the KelpDAO incident. We have some Clarity Act updates, and I'm actually going to restructure this so that we start the conversation with something boring, the government, talk about something negative, Arbitrum's response to KelpDAO, and then we can go on to use cases as we see them popping up across the broader blockchain and crypto space. So the first thing I want to start with today is the Senate bill, the Clarity Act, the market structure bill. Let me take a quick sip of my Waterloo. As is to be expected, we should not be expecting anything from the Clarity Act in April, which unfortunately puts our feet to the fire because more or less August, September is the timeline being thrown around for when we need to get the market structure bill past Senate Banking Committee, past Senate Ag Committee, and to the vote on Senate floor. Or else we run into issues with this class of Congress getting ready to migrate out of their roles in Congress, and we see the midterms start to take effect. So tensions are building to get a hearing on the calendar to advance crypto market structure bill legislation. Last night, Monday, Senator Tom Tillis talked, and he's a key negotiator on the Senate Banking Committee, told reporters that he doesn't expect the committee to hold a hearing to amend and vote on the bill in April. As of last week, a source familiar with the matter told The Block, I love The Block, that draft language currently reflects prior language that would ban rewards on idle stablecoin holdings and accounts while allowing yield on activity like transactions. So if I'm just intuiting what this is saying is yield based on activity. And anybody who uses Coinbase, there's like Coinbase One. You also pay certain maker and taker fees depending on the amount of volume that you trade on the platform. So this sounds kind of similar. The more volume you have, the more access to interest and yield you might have. And at this point, Tillis goes on to say that it would be difficult to make substantive changes to the text at this point. Rather, a source said that. Sorry, not Tillis. Pressure has been mounting to get the bill passed with a push to get a markup hearing in April, which it doesn't sound like we're going to have. If this legislation advances out of the Senate Banking Committee, it still needs to be combined with Senate Ag's version and then go to the vote before being reconciled in the House. Let's see. Senator Bernie Moreno, a Republican out of Ohio, warned that the next few months would be critical, adding that if the bill doesn't get passed by May, digital asset legislation will not pass for the foreseeable future. Tillis told the Senate Banking Committee Chair Tim Scott that the panel should be looking at May to mark up the bill. And this is really, really getting close to the deadline for how long these processes take to operate in DC. We want a Clarity Act. We want law because we want crypto companies in the US to be able to know how they can launch a product and they can sufficiently decentralize their token holdings and become a blockchain and crypto project that doesn't have to worry about a rogue regulator coming after them at some point in the future when administrative winds change and maybe a US administration doesn't like crypto like the previous one. That being said, the conversation I had today with Vivek was really enlightening because more or less he said that the toothpaste is out of the toothpaste holder, out of the tube. And the banks are now incorporating stablecoins, and you can't go back. You can't undo what's already been done. And so even if winds change in 2028, 2029, when we have a new administration, there's always going to be stablecoin law. And so at least we have a little bit of our stake in the ground. So I'll leave it at that. We're going to be following Clarity Act as we keep doing the daily digital downloads. Moving on to the KelpDAO hack. The exploiter has begun moving funds across any avenue that it can. And we'll dig into this in 1 second, but Arbitrum has frozen a large portion of these funds. However, $1.5 million was moved from Ethereum mainnet to Bitcoin through Thorchain, a decentralized swapping protocol. I'm a huge fan of Thorchain. Unfortunately, with free market solutions also come the ability for anybody to use them. And Thorchain has become a tool for North Korea to swap assets. And it's super unfortunate that that's the case, because I also believe that anybody should be able to swap assets if they want to, regardless of where you live or under what regime you live under. And this is why I love Thorchain, because it's permissionless and it's an atomic swapping protocol that lets you swap native Bitcoin for native ETH without using an exchange. And while it's so beautiful and the way that it operates, technically speaking, unfortunately, it's also used for crime. But hey, so is the dollar. I'm not sitting here saying that Thorchain is good or bad. Just like I'm not going to sit here and say the dollar is good or bad. Even though they keep printing more and more dollars and devaluing our currency and devaluing the time that you spend working for this currency. But that's not the purpose of today's stream. Blockchain security firm PeckShield said that the exploiter had begun moving roughly $176 million in stolen funds through Thorchain, Umbra, Chainflip, and BitTorrent. Additionally, Ember CN highlighted that the attacker had started shifting about 75,700 ETH off Ethereum after Arbitrum's freeze, including smaller transfers through Umbra. So we're currently watching in real time DPRK moving their funds that they stole via KelpDAO. Anything else here? Layer Zero yesterday said, or the day before said that it was Lazarus Group from North Korea that was the likely culprit. But the juicy information that arose yesterday after our live stream is KelpDAO released its post-mortem, which is just super, super thin. It honestly took me like a minute to read. And long story short, KelpDAO says that all of the fault is on Layer Zero. 2 RPC nodes hosted by Layer Zero were compromised. A DDoS attack was launched against a third RPC node. That Kelp itself detected and paused relevant contracts on mainnet, Ethereum mainnet and L2s after it noticed the anomaly and activity, blacklisted all wallets associated with the exploiter, and engaged SEAL 911. So look, and they also denounced their one-of-one DVN setup, which they're blaming Layer Zero as saying is the default setup. Where if you recall yesterday, Layer Zero was saying that they advise all entities using their omni-chain, cross-chain bridging infrastructure. They advise all entities to use a multi-DVN setup. Long story short, both sides are pointing the finger at each other. Aave itself is having a hard time reconciling how it's going to swallow the bad debt. So for you, the retail user who's caught in the middle of all of this, all 3 of the big players, KelpDAO, Layer Zero, and Aave, are pointing fingers at each other and blaming one another. So this is an ugly situation where, unfortunately, nobody's really taking accountability. And because we're stuck in this situation, we have to rely on other actors to police. Drift protocols, a lot of the stolen assets from Drift Protocol, which was the major hack in Solana ecosystem 3 weeks ago, a lot of those assets were moved via USDC. ZachXBT called out Circle for saying that Circle itself didn't freeze the assets in a quick enough time frame. And that allowed the malicious actor, now we know DPRK, North Korea, to be. And Circle basically came back and said that they're stuck in a moral dilemma because they don't really freeze assets unless a government tells them to, unless legal enforcement tells them to, unless law enforcement tells them to. And I get it. Like after what now? Okay, so Circle freezes these assets. Now what are they responsible for? How big of a hack do they have to freeze assets? What happens if they start freezing other assets that aren't malicious at all? It's a slippery slope. But that being said, we don't have to pontificate on that today. Arbitrum froze $71 million worth of ETH that were stolen in the KelpDAO exploit on the Arbitrum chain. The Arbitrum Security Council is composed of 12 individuals, and 9 of the 12 voted to freeze 30,766 ETH held in an address on Arbitrum 1, which is linked to the KelpDAO exploit. It's roughly worth around $71.1 million, and the funds will remain frozen until further action is approved through Arbitrum governance. The team said, quote, "The Security Council acted with input from law enforcement as to the exploiter's identity and, at all times, weighed its commitment to the security and integrity of the Arbitrum community without impacting any Arbitrum users or applications. End quote. And so we're now getting into a debate about the levels of decentralization. And you can go onto crypto Twitter and see all sorts of hot takes about this. People are saying that Arbitrum isn't sufficiently decentralized, that they basically were able to wave a magic wand and not basically like stop a wallet from being able to be a wallet on chain. Now, the nuance here is that yes, this is a ton of ETH. Yes, this was linked to a bad actor's wallet. And yes, there was a governance board that had to debate and deliberate on this issue, and an overwhelming majority of them voted in favor. The Security Council on Arbitrum is voted in by Arbitrum token holders, and the board has a year-long term for each board member. So in theory, the Arbitrum community voted on these folks. And while people are rightfully concerned that there is a clawback mechanism on the Arbitrum network to be able to get funds back, they're asking out loud, does this make Arbitrum a decentralized blockchain? I would actually argue, and remember, everything about decentralization is a spectrum. Nothing is ever 100% decentralized, and nothing is ever 100% centralized. Or you have to make trade-offs and decisions on that spectrum for where and how you want your product and project to be decentralized. Centralization and decentralization offers pros and cons, and you have to weigh in which pros and cons you're willing to accept. I would argue that Arbitrum is sufficiently decentralized for a decision like this. While yes, a blockchain network that is supposed to be immutable, permissionless, and borderless did freeze funds, it was voted on by a council that was elected by token holders. And if we're really, really getting down to the bare bone essential of the question, remove your qualms and concerns about blockchain decentralization from this question. Should a state actor be able to steal tens of millions of dollars from a protocol and from protocol users? Now, you can lambaste me, you can call me dumb, you can say that I'm a centralization maxi, I'm a cuck, whatever you want. I don't think that bad state actors should be able to steal from us. And in this instance, the Arbitrum Security Council acted within their mandate and made a decision, which we just saw the crypto industry getting mad at Circle for not doing. Everybody was getting mad at Circle for not freezing the USDC from the Drift protocol hack. So we can't have our cake and eat it too. Either we want complete and utter decentralization, and that means that state actors can steal our assets, or we have elements of centralization baked in to the security practices of our blockchain networks, which allows a council to freeze stolen funds. What is the Security Council? The primary role of the Arbitrum Security Council is to address critical risks associated with the Arbitrum protocol and the ecosystem. The Security Council is responsible for making time-sensitive and emergency response decisions that protect the interests of the DAO, its members, and the broader Arbitrum community. I would argue that the Arbitrum security basement of the RSETH token and the lack of ETH backing the RSETH token, the bad debt on Aave and other platforms, and more ripples from this event to continue shaking out. So we'll probably talk about this again in another daily digital download. I want to move on to one more story about scammers before we get into positive news for the rest of the day. Who would have thought when Bitcoin was made in 2009 that we would be talking about scammers demanding crypto as clearance fees, pretending to be authorities for a pariah state to allow cargo ships to move through the Strait of Hormuz? Fraudulent actors are reportedly demanding crypto payments from shipping companies whose vessels remain stranded west of the Strait of Hormuz, promising safe passage through waterway in exchange for Bitcoin or Tether. Unknown parties are impersonating Iranian authorities and are targeting some shipping firms with the scheme. It's not funny, but I just cannot believe that crypto is a part of geopolitical tensions now in such an interesting and unique way. In one message flagged by Marisks, and Marisks is a Greek maritime risk management firm. The sender told shipping companies they would need to submit documentation for review by Iranian security services before a transit fee could be determined in cryptocurrency. The fraudulent actors then went on to say that with the payment, the vessel could cross the strait unimpeded at a pre-agreed time. At least one vessel has tried to exit the strait. They did this 3 days ago, and they were hit by gunfire from Iranian boats, and they might be the victim of this fraud. I only point this out because, it's bad actors taking advantage of a nasty geopolitical situation. But B, crypto is an integral part of the story. And it's just really interesting to see how our little technology is a part of a growing global story. Let me make sure we're still streaming. Sorry, folks. Okay, we're still streaming. Awesome. Anyways, moving on. DoorDash has begun offering stablecoin payouts via Tempo. You might remember Tempo from stories such as last week where everybody said it's not a real decentralized blockchain, and it's not a real blockchain because it's a corpo chain and it's not real ZK-empowered privacy solutions in their zones and all this. And my clapback, my argument is, look, Tempo told you who they were right up front. They told you who they're building for right up front, and you can see who's buying into that vision right up front. Companies that are using Tempo include big scale names. You know them: Visa, MasterCard, and Stripe, and so on. So anyways, DoorDash is going to begin doing payouts in stablecoin because DoorDash operates a three-sided marketplace across more than 40 countries. So they're already dealing with issues and dilemmas associated with the differences between local currencies, local financial rails, and working on different financial rails internationally. The platform connects consumers, merchants, and delivery workers that are called dashers. And with such a large-scale operation running on several different payment rails and exposed to different foreign exchange volatility and settlement timelines, bottlenecks ultimately arise, and stablecoins are a solution to this problem. DoorDash leadership said, quote, there's a real promise with stablecoins transforming financial infrastructure, and not just in America, but globally. We want to be a proactive participant and not just passive, end quote. So stablecoins are emerging as a non-crypto native use case that the rest of the world is using. They're using stablecoins for meeting their day-to-day needs, and they're not decentralization maxis or crypto maxis. They're just using this technology because it behooves them and it benefits their lives. DoorDash said stablecoins have long been central to crypto trading, and that DoorDash is moving payments to Tempo's network because it's getting closer to stablecoins being used as working money. And findings from BVNK, Coinbase, and Artemis suggest that this trend is solidifying. Again, Tempo is a blockchain built specifically for payments at scale, and this protocol was incubated by Stripe and Paradigm. Tempo now says that the network is serving as a core blockchain infrastructure for Stripe's money management capabilities, allowing businesses to hold, send, and receive stablecoins. And enter DoorDash, a company that is embracing the blockchain infrastructure and utilizing it because it solves headaches they have. You might not like the underlying blockchain if you're a cypherpunk decentralization maxi, but if you are excited about blockchain becoming mainstream, this story should be music to your ears. Speaking of blockchain becoming embedded in the real world, Pokemon trading card game marketplaces are nearing their record highs as tokenized collectibles are showing staying power. Weekly revenue across Pokemon marketplaces rose to $5.38 million for the week ending in April 6th, just shy of its all-time high set in September of 2025. Now, in September of last year, that all-time high was concentrated in a single collector crypt pump week due to its token generation event. So now, if we're looking at what this new all-time high volume across trading card game marketplaces is saying, the second order read is saying that tokenized collectibles have moved past the NFT adjacent view that they had before and are becoming a subcategory of real-world assets. Usually when we think of real-world assets, we think treasury bills, tokenized credit, private credit, commodities coming on chain, oil, gold, wheat. But an RWA is also a real-world asset. And though a trading card is just a physical card, this is real. It's in my world, and this has tokens on it. It's an asset. Pokemon cards have value associated with them. So, the Pokemon trading cards are becoming a workable RWA subcategory. The tokenization layer of these platforms is being used as a liquidity wrapper rather than a purely speculative venue. Another instance where tokenized cards are providing value for users outside of, tokenized or token degens, hoping that number go up because, why not? This is NGU technology. This means that cards are flowing out for physical delivery, which validates the pricing function of the on-chain market. Furthermore, this creates a template for the broader tokenized IP and collectible thesis that NFT era projects failed to produce. So here we are, 2026, 5 years after the NFT boom, and we're seeing NFTs serve a real purpose. Yes. This is amazing. Yes, the 2021 boom saw a lot of froth from PFP trading. A lot of people made a lot of money. Almost all of those NFTs are down bad now 5 years later. But as with everything, ultimately use cases do arise out of innovative technologies. And here's a perfect example. Coinbase incubated X402 protocol has unveiled an app store for AI bots. Coinbase's X402 protocol is maintained by a consortia of over 20 leading tech and crypto firms, including Cloudflare, Stripe, AWS, Google, and Visa, as well as Base, Circle, and the Solana Foundation. Base and Solana working together. And they recently released a platform for goods and services available to human and AI agents. The agentic.market platform will help surface hundreds of tools now accessible via the Internet Native Payments Protocol. At its launch, agentic.market will feature services from dozens of providers placed into 7 major inference, data, media, search, social, infrastructure, and trading categories. And now, providers like OpenAI and Venice in the inference category, Bloomberg and CoinGecko and data, LinkedIn and X and social, AWS Lambda and Alchemy and infrastructure, Banker and Coinbase Rat and trading. Now these providers can permissionlessly join the marketplace for people and agents to buy their services. X402 and the wider world of agentic commerce, where AI bots direct transactions with or without direct human oversight, represents something of a new business line for many online service providers. There are an estimated 69,000 agentic bots on X402 that have cumulatively made over 165 million transactions, representing more than $50 million in volume. Now, a month or so ago, it did come out that X402 is only doing about $28,000 a day in volume. So this is still a nascent and emerging use case in industry, and time will tell if agentic.market really does have product market fit, but Coinbase is saying they think they do. And if the AI agentic future is the true future, then yes, our agents are going to be buying things on our behalf, and we're going to want them to be able to buy things on their behalf so that they can operate in the realms that they see fit to benefit you and me. And our last piece of news for the day, Grayscale has amended its Hyperliquid ETF and is now going to be using Anchorage Digital Bank as its custodian as opposed to Coinbase. The move is significant given Coinbase's outsized role as a custody services provider for the broader crypto ETF landscape. Coinbase's crypto trust company is the primary custodian for nearly all of spot traded Bitcoin ETFs, with Fidelity being the notable exception because Fidelity Digital Assets holds its funds underlying Bitcoins. Fidelity is just an OG in blockchain and crypto. They were mining Bitcoin and Ethereum in 2014. If you're looking at a TradFi native entity that is crypto pilled, go look into Fidelity and what they're working on. Anyways, this is a big deal largely because I believe Hyperliquid is going to be one of the first blockchain-enabled platforms to break in to mainstream commodities trading simply because Hyperliquid offers a better service than their centralized peers because it is decentralized and operates 24/7. Of the 10 markets on Hyperliquid, the top 10, 7 of those top 10 are trading volume for non-crypto assets, oil, gold, etc. So Hyperliquid is still unavailable to US traders. That being said, there's clearly demand and understanding for the role that Hyperliquid plays, and there are investors and speculators that want to allocate a portion of their portfolio to the Hype token. There's also a large swath of people who want to do this via equities, who want to do this via ETFs. They don't want to go on chain. They don't want to have to deal with regulatory uncertainty. Hyperliquid's Perps DEX platform is currently ring-fenced in the US. However, Coinbase listed the Hype token in February following the protocol's massive growth in 2025. Why this is interesting? Because Grayscale updated its Hype ETF amendment to note that the fund's staking optionality is subject to regulatory approval and that it'll use CoinDesk's Hyperliquid benchmark extended rate pricing data. We still haven't seen broad integration of staking in ETFs yet. Just this year, we started to see the first Ethereum staking ETFs unfold, where ETF holders are able to accrue the underlying asset that is stakeable. Think AVAX, think Ethereum, think any proof of stake token that you've ever held. You stake it to a validator, you earn that token in return. And so we just started seeing ETFs launch that embed this staking feature for the clientele that buy the ETFs. And so even though Hyperliquid is you're not able to use it in the US, that being said, people do want exposure to the Hype token because they understand the value prop of what Hyperliquid offers: 24/7 trading for commodities markets. Hyperliquid is the largest on-chain perps DEX, and although it's barred from use in the US, the team behind the protocol recently funded the Hyperliquid Policy Center lobbying group based in Washington, D.C. So maybe we see Hyperliquid make a big push into becoming a compliant platform that can operate within the US. And that will do it for today, folks. Thank you for tuning in to the Daily Digital Download today. If you haven't yet, head down to thesmarteconomist.beehive.com to subscribe to our weekly newsletter, where we use these daily live streams to help mold a weekly newsletter that helps sift through the signal that all of your favorite KOLs and thought leaders and respected individuals in the blockchain space let slip through their cracks. That's what I want this weekly newsletter to be. The signal that all of the other signal missed. So, folks, with all that said, have a great day. Have a great Tuesday. We are an industry in flux. We're seeing hacks happen, but we're also seeing progress get made on regulatory and political fronts and the integration into mainstream adoption. So there's the good, the bad, and the ugly, but you know what? We've been here for years, and we're going to continue to be here for years. So with all that said, thank you so much for tuning in to the Daily Digital Download.